Care Bear countdown. 3, 2. Does your kids like Care Bears, Amar?
Nope. We actually don't have a TV.
Why? That's what I'm talking about. You don't have a TV?
Yeah, we're since 2009 we don't have a TV. So I used to work in New York City, and how they do it there is like the building has one provider. So like we're living in this building and it only had Verizon as a provider, and when they have a monopoly on that building, they charge a lot. And I was like, I'm not paying that much for internet or TV, and we cut the cord since 2009.
So do you have no, not like what, the Roku things or whatever they're called?
No, we don't have Roku. I mean, we have Netflix on the laptop, but
so
that's about it.
Like, so what do you, like, if they want to watch TV, they just watch Netflix on the laptop?
Well, they don't want to watch TV because they've never watched. I mean, like, we go to grandma's house.
What? They were quiet for the last 3 hours. No. Hey, they were literally quiet, laying down for the last 3 hours, and suddenly they jump up. Would you stop? Dude, that's fantastic.
Hey, Josh, I'm going to share my screen so we can have the disclosure on the.
Did I tell you, TV is a. Go ahead. The TV is it's just brutal, man. That's fantastic. I didn't have a TV growing up, man, and that's one of the reasons I think I'm so inquisitive, because I read a lot, because we had no TV. We literally had no TV at all, and as such, you had to find other creative things to do to keep your to keep yourself occupied. You know what I'm saying?
Yeah, and I think like jobs in the future. I mean, now knowledge is. You can just Google stuff, right? And so creativity is going to be increasingly large percentage of future jobs, at least in the U.S.
Dogs. Harry said dogs want to watch TV.
There you go.
Let me add the disclosure here. I think that's right. Actually, I was talking to a guy the other day. I said, man, I can't remember what it was. We're just talking about. I said, don't overlook the creative issues, because creativity is robots and AI can't take over human creativity. That's for sure. You know what I'm saying? So. All right, so everybody, don't forget to subscribe to Amar's channel at Client First Cap Learning on YouTube. So subscribe if you haven't yet, please. Jill says she only had rabbit ears and small black and white growing up. Harry says I use over-the-air antenna himself. Yeah, right on. We got Alan San Diego with us. Jeremy Rhodes is here from Maine. The interesting thing is we had a tiny black and white quasar. Was it 8 inches or something like that? And I remember, I didn't know the Incredible Hulk was green because it was black and white, so you couldn't tell they was green. You know what I'm saying? That's how old I am, Amar. I'm an old man, crusty old man.
So
go ahead.
These disclosures here are basically saying everything is for educational purposes. Yeah. We haven't considered your specific situation. We're just here to give you some content so you can think about and come up with your own conclusions. If you need help, you can reach out to Josh and I, and we'll be happy to help. I think, why don't we just jump into it?
Yeah, right on. All right. So you want to start?
Yeah. Let me start with a question so we can see how many caregivers will there be in the United States that are unpaid? So this is like a family member or somebody else that would be helping in the millions. What number? So maybe I give some choices. What do you think, Josh?
Yeah. Can we do a poll? Can we do a poll where people can answer?
I don't know. Okay. This is your technology.
I know on Zoom you could, but I don't know how to do it here. But yeah, all right. No,
we'll have to figure that out. So it's just for the time being in the United States.
Yep.
How many millions of people are giving care and they're unpaid? So I'm going to just start with some numbers. 10 million, 20 million, 30 million, or 40 million.
Wow.
What do we think?
So I guess it's got to be over 3 million, huh?
Yeah, it's going to be over 3 million.
So 10, 20, 30, 40. So A, B, C, or D. I'm going to say This guy said 50. I assume 50 million or lady. So I'm going to say C. Yeah. All right. Got a couple 20s. I'm going to say C, which is 30 million.
It's not 30 million. There were 41 million people giving care for a family member unpaid in 2015. And that's why long-term care, not insurance per se, but just having a plan around needing help is so important. And I always remember two things that I remember about long-term care. Number one is personal experience through my father, but also I had one of my clients who was Army. It wasn't a Ranger, but he was in the Army, and he said this: if you don't die, you grow old. Yeah. If you grow old, you tend to need more help, and having a plan for that help is what long-term care is all about. And so
just on that. So real quick, is that just for old people, or is it for, like, you are a long-term care provider right now for your children, are you not? So how's that?
No. These are people that need care. The average age of the caregiver was 49 and a half or 49.2, and the average age of the recipient was 69.4.
Wow, that's
through
nuts,
the survey, man. Through Morningstar. Yeah. Mm-hmm. So we're talking about people that need help. And the other thing that we should point out is that it's disproportionately caregivers who are female tend absolutely. To give care. And when we think about this from a planning perspective, but also a legacy perspective, is that if you don't have a plan in place, then you're affecting different chains of your family, right? Like, it could be your spouse, it could be the next generation. I have one client where one of their grandchild is he's paying his grandchild to help him out, and you know, this is why I think long-term care is so important. It's not that you should buy insurance; it's that you should have a plan in place. You know, most people will self-insure. I think that the average cost, I have it in here. I'll have to look it up, and we'll do that in our next poll. Yeah. But so real quick.
Go ahead.
Yeah. So disclosures, again, educational purposes.
Oh wait, I got to bring it back up. There you go. All right, cool. Good. Right. We're good. But I think just real quick, I think Jeremy makes a good point. It's the female nature to nurture. I completely agree with that inherently much. In fact, and then real quick, Amar, folks, always remember, long-term care is about caring versus curing. Always, you put that in your head. Long-term care is caring. Going to the hospital outpatient, that's curing. We're talking about caring, and that's where it gets can be very expensive and long, lengthy too. All right, go ahead, Mark.
Yeah. So and I want to make sure that we cover some of the things around the cost too, and maybe we'll do that at the end of the slide. But here, just like Josh said, right? It's this middle sentence here is that, you know, Medicare, Medicaid will not cover most of the expenses associated with care. And sometimes it's not the care that you're thinking about. It's, you know, getting out of bed, changing your clothes. There's these things called daily activity, ADLs, activities of daily living. Includes like pooping, brushing your teeth, putting your clothes on, able to eat, walk. There's one more that I'm missing. Getting out of bed, I think, is
transferring. That's one I know.
Transferring, yeah. So most insurance companies say that if you can't do 2 out of the 6, then that's a qualifying for a long-term care event. Yep. And if you don't have a plan, then you're just going to be spending down your assets. And then after you spend down your assets, then you're actually looking at, one of the state-run type facilities and
Medicaid. Yeah.
Medicaid, yeah, and the facilities that are run by these, you know, some of them you have to have a certain percentage that are Medicaid, and the rest is private pay. You know, so they get subsidies and whatnot. But I would highly suggest take a tour of some of these facilities and say, like, is this where I would want to be? Is this where I would want my spouse to be? And it is something that will become an emotional decision. It could be stress, stress around that. So a couple things, Josh, you want to add anything before I pull up some questions here?
Well, I was just going to say, just remember, you can still have a plan for long-term care without buying long-term care insurance. I just want to be very clear on that. Long-term care insurance is not the only plan for long-term care. A lot of times, long-term care is you do self-insure. I mean, that's fine. There's nothing inherently wrong with that. We're going to talk about some insurance products here today for those of you who are interested, because the market has changed so much. Because Nancy says, I'd like to consider it, but I'm not sure. It might be too late for her. I don't know. Oh, no one knows. But I'm just telling you right now, as you get older, it becomes prohibitively expensive for long-term care insurance the traditional way. But there are other ways to skin this cat. And for most people, just self-insure. That means just pay out of pocket. It's okay. But
have a plan to pay out of pocket. Like, I work with clients the average age is 73, 74. And their parents grew up through the Depression era. And even if they have the money, it's hard to spend that money on care, right? And so so that's something to be cognizant of. One thing I was saying,
Amar, and Denise, she says she took off work for 3 months once and 1 month another time to take care of her dad. So they're going back to your initial thing. The second time was 1 month because he passed away. I watched him from the time I got up until the time I went to bed.
It's hard. I mean, that's got to be. It's got to be very difficult. I mean, and so when we're talking about the cost of care and stuff, so 63% of people estimated who are 65 today will have little to no out-of-pocket expense, right? But 40% or 37% will. And I just want to give you some numbers here. So the estimated median annual nursing home costs for a private room in 2030 is estimated to be $142,000 a year. I mean, that's a lot, right? So a lot of people or a lot of individuals will have to look at shared rooms, or I think the more people I talk to is that they want to stay in place. They want to stay in their own home. And so having care come to your house part-time or full-time can range from between $19,240 and $51,000 a year. And that's what we're talking about is how are you going to cover that expense? So
it's $250 a day for a live-in aide here in New York, says Condo Guy.
Yeah, I mean,
it's
expensive. And a lot of times, one of the things that I've heard, children will get care or figure out a plan. Jeremy says move in with your grown-up children.
No.
Sometimes your children are just about to retire, and they're at the edge of their seats, looking at this freedom of retirement and to be able to do all the things that they haven't been able to do. And so there's this really says. If you're not going to self-insure, there's basically 3 types of care that you can purchase, right? There's long-term care insurance, right? Just the traditional vanilla long-term care insurance. There's a hybrid long-term care policy through an annuity policy that will give you income and a rider that would pay for some care. And then there's also life insurance policies with long-term care riders built into them. Now, we don't really cover the life insurance with long-term care riders a lot because it is expensive. Inherently, you have 2 big costs there. You have the cost of life insurance and you have the cost of care. And they're going in opposite directions, right? So the longer you live, the long-term care cost goes up, but the need for care cost goes down. Yeah. And I guess there's this arc, and this arc peaks at the time that you probably need either one of those the most, and it becomes really expensive. So I think the biggest benefit to some of these life insurance with long-term care policies is if you already have a permanent insurance policy, and you can 1035 or 1031 exchange it into another policy that has one of these riders in them. So it seems to be a good thing. So what's
Well,
it?
here's Harry. He's paying $1,000 between for just both a year. If you have an older policy, I just tell you these older policies are freaking worth their weight in gold because they underpriced them. Now they're doing the exact opposite. Now they're overpricing them. So
it's like and the insurance company is like a pendulum, right? They swing. Yeah. They went from way underpricing to way overpricing. One of the problems is like they don't want to have bad press, right? And so it's hard for them to kind of change some of these older policies.
You have that. You want to do the example of the thing, or you got another? What do you got now? I can't remember if we're going to do the example next, or okay? There.
No, let's go through the slides, and there's a area where we can.
All right, man. You just tell me when the slides are done. We'll bring up the example exactly.
So picking the right coverage, right? So most important is to figure out what type of coverage you need, right? Somebody that's in California doesn't need the same policy that somebody that's in Texas, because even the state has different things that they would co-cover. So in California, if you had a long-term care policy, they had this California rider that you could get that it would cover that much in assets before the state would step in. And so there's different riders. It's kind of like auto insurance, right? There's different bells and whistles. Yeah. You have to figure out which ones apply to you, which ones that you want. One of the ones that is your premiums, right? So do you pay annually? Do you pay monthly? Do you pay quarterly like Harry? Sometimes there's a break in cost if you pay annually, right? Sometimes some of these policies have a lump sum where you can pay all up front and then not have any subsequent payments. It also matters that like what your health is, right? It's kind of like life insurance where you can get table rated, meaning the higher likelihood of claim, the higher premium that you would have to pay. Same thing is true with long-term care, but it's in the opposite direction. If they think that you're going to live a long time, then you're going to have more. There's going to be more inherent costs there.
If you see me laughing tomorrow, I'm not laughing at you. I'm laughing at my dogs because they are nuts. But yeah, just so don't think, why is he smiling? It might say something stupid. It has nothing to do with you. These guys are nuts.
Yeah. Focus, Danielson. Anyway, so sometimes with long-term care, if you have an annuity and you can take payments from your annuity directly to your long-term care provider, you can avoid some of the gains in the annuity being taxed, right? So these are things that you want to consider. The only other thing that I could think of that we didn't cover in here is inflation protection.
Yeah, man.
So there's two different types of inflation protection. There's simple and then there's compound.
Yep.
Simple, let's say you have a 3% inflation protection, it's 3% off of your base amount. So if it's let's say $100 a day, and then next year it's 103. The year after that, it's going to be 106. So that 3% is based off of the base amount. Yeah. Compounding says, what is your benefit at the time, and then adds the inflation on top of that. And sometimes, like the devil's in the details, some of these inflation protections, it's pegged to either CPI or they give you just a max. Yeah. Right. So like you get a stated amount, like 3%, 4%, whatever you put in your policy. Sometimes I've seen as high as 5%, but
like here's one. Jill's got this one right here. Hasn't moved a penny in premiums, but 3% per year compounded. You're never going to see this kind of policy again. So I mean, those compounding policies and with inflation, those things are expensive. Which is why they know the insurance companies aren't stupid. They know there's a risk, they know there's a demand, and they know that their policies are expensive. That's why they offer these other policies. There's other options. Yeah, keep going, Amar.
Well, I guess the problem has become, because it's become so expensive, traditional long-term care is there's not that many providers anymore. In what would you say, like 2005, there was at least 20.
Something like that, yeah, it's crazy.
And then now it's down to maybe 2 or 3 that are underwriting vanilla traditional long-term care policies, because the actuarial tables were greatly mispriced.
Big time, yeah.
So what we're left with is a hybrid long-term care policy. So this is taking like another insurance product and adding a rider to it to make it have a long-term care benefit. And I think
it's army knife of insurance products, essentially.
Yeah, and Josh, when we were first starting, Lincoln Money Guard was like the product that kind of pioneered.
Yes, love the Lincoln Money Guard. Absolutely, yeah. I sold some Amar. I sold some Lincoln Money Guards, as a matter of fact.
Yeah. And so basically, these policies work in a traditional way, in the sense that there's the annuity product or life insurance product, whatever it is. And then there's a long-term care rider that will give you a multiple of either income or death benefit amount that you can use for long-term care expenses and not have a penalty or a taxable event. Some of these are included, like, why don't we just go through the example now?
Oh, absolutely. Amar, so one of the reasons I like these hybrid policies is because, like a condo guy says, his mom paid $370 a month just before she died, and she never got to use it because she chose a 6-month elimination period. So remember, Medicare essentially covers you for like 100 days, I think, Amar, and then after that, you're on your own. So basically, it's 90 day, a 3-month elimination period that a Medicare will cover. Essentially, is kind of the rule of thumb. So in this case, condo guy's mom self-insured for 3 months, so Medicare paid for 3, she paid for 3, and then she died and never got to use it. So what happens is she paid a boatload of money into the policy and she never got anything for it. Now,
I wonder, did she get a return of premium or anything like that? Maybe the condo guy can say that.
Well, that's a good question. So condo guy, see if she got her money back, because what happens is here, especially with that kind of premium, I bet she did, but I don't know. But he'll answer, I imagine. But Amar, what happens is, well, you know this, is that you pay all this money in, you die, you don't use it, and all that money was lost. Now, before people start screaming bloody murder, that's like saying, I wish my house would have burned down so I could use my homeowner's insurance policy. You know what I'm saying? It's the exact same thing. That's what insurance is there to protect against catastrophes. But insurance companies aren't stupid. No, she didn't get that offer, he said, Amar. New York, they live in New York. The hybrid policies, yeah, if you want to bring that up, I think should I remove this? You have it up there, the
Yeah, let me bring that up. But before we bring that up,
okay, go ahead.
I would just say that the average age of people looking at long-term care, let's take a guess at this.
Yeah, there you go.
We're going to say 50, 55. Well, no, let me do this in 2.5-year increments. So 50.
Oh, no, do 5-year increments. It's easier.
Well, the number is an exact number. Okay. That's engineering me. So, all right, so we're going to do 55, 57.5, 60, 62.5. Right? There's 4 options there.
I'm saying 62.5. That's what I'm saying. So I could go down on the record saying 62.5. I don't know that to be true. Amar has not shared these numbers with me yet. So Jeremy says 55. Jeremy's a youngster. So for Jeremy, 62.5 is like freaking, Grandpa Jones, even though I'm 50 right now. Anybody else? So what do y'all think? So,
all right.
Let's keep letting a couple more go. Jennifer says 57.5. Jill says 48. That wasn't the question. Jill, we didn't ask when you got your policy. Pay attention. Directions, Jill, directions. 57.5 says Scott. Harry says 40. Jimmy says 57. All right. So what's
so Jimmy is right. Jimmy and Big E from Texas.
Wow.
So 50%, 48% of all long-term care solutions are bought between the ages of 55 and 64. And 57.7 is the average age of a long-term care insurance policy purchase.
Oh, that's a purchase, though. That's not when the people start looking.
No, this is when I said, when do people purchase their long-term care?
I thought you said when do people start looking. Okay, gotcha.
No, they start looking. Yeah, so I mean.
So I guess I wasn't paying attention. Is that what you're saying?
Yeah. Anyway, so of these policies, right, the number of hybrid life long-term care or policies in 2018 was 461,000, meaning a large percentage of people are now defaulting to this hybrid policy. So let's pull up one of these policies.
Yeah. All right. Want me to bring it up?
It should be there you go.
Cool.
Did you want to go through these policies?
Yeah, absolutely. So let me just start with did you ever sell any Lincoln Money Guard when you were a young broker, a young whippersnapper?
I was purely in investments.
Okay.
This insurance thing is last decade?
No, right on. Well, exactly. But I mean, there's some sweet commissions in them. That's for doggone sure. And remember, a lot of the salespeople get 65% of first year premium. Just I don't know. I'm sure that's still the case. Now they got these ones now, like Amar. He does it it's a fee based policy, and he can explain how that works if you ever want to talk to Amar about this. But a lot of these insurance guys, the reason they got these freaking houses on the water is because they make a lot of money in commissions, man. It's 65% of first year premiums. Anyway, so when I sold Lincoln Money Guard, I had a couple just both retiring from Merck in Elkton, Virginia. And this is the first one I ever sold. And they each dropped in $50,000 Amar. So I think they're both in the mid 50s. They both put in $50,000. They had like I just remember it's 50,000, 166,000 for long-term care benefit and 212,000 for a death benefit. So basically they could get the 50,000 back at any time and cancel the policy. They could use long-term care for like 166,000 if they ever needed the long-term care. And if they died, they get 212,000 back to their estate. So it's pretty sweet, man. It's like you knew that you're going to get your money back from one way or the other. By long-term care, by death benefit, or by just getting your money back because you don't need it after all. So that was pretty good. So let's go into this. So this is I wish hard for me to see this. All right, so go down to the next. Yeah, go down to the next one, Amar, would you? Shoot. I'm gonna have to. I can't see that. Let me bring up.
Why don't you share it on your screen?
Yeah, so exactly. I was right on. So let me bring up. Hold on. I'm gonna share on my screen 100%.
And while we're doing that, Nancy, where is it? Yeah. So what age can't you afford to purchase care? I mean, the care just gets more expensive. And so that depends on everybody's situation. One of the things, again, we want to reiterate is that you don't have to buy care. You can also have a plan to, what you want to see happen and kind of self-insure some of that, because at a certain point, the cost of getting insurance may be way too expensive. And that point is, depending on your personal situation, right? It's what could be expensive for one person may not be for somebody else.
And along those lines, I have long-term care, as I told you guys a million times a Sunday, for the old ball and chain and me. We both have long-term care from Knights of Columbus. It's a fraternal Catholic organization. And the reason we have it, and I think I bought when I was 40 and the old ball and chain was 36. The reason we got it is because there is a significant sizable population of people under the age of 65 who need long-term care. And as such, if something were to happen to me, mentally, and Charlotte couldn't take care of me, not only would my income be gone, but she have to put me someplace. And she'd be broke, man. She'd be broke. So I bought it, and that's a traditional long-term care policy, which I have. But it does get more expensive as I get older. That's for doggone sure. All right, so I'm going to share this, Amar. This is going to be the North American one. All right, so can you hold on a second? I want to see if
we can see your screen.
All right, sweet. So this is fantastic. All right, so this one I was looking at, and I don't know who Samus Financial is. I got no issues with saying I got no knowledge of these people at all. And you can see us tomorrow?
Yep.
All right, sweet. All right, so what I want to do is I want to go into as the problem is with any kind of life insurance product is you got all of these product terms and stuff like that. And what we're going to do is we're going to come down here first and foremost, and we're just going to all right. Wait, is this long? Was this this was the annuity, valued annuitant. This wasn't a long-term care thing. This is a flexible deferred annuity contract. So I pulled up the wrong one. This is your annuity contract, Amar. That's actually pretty good. I didn't mind this at all. Was there a reason you wanted to show this right here? Because this was actually pretty interesting to me. I thought we might talk about this, but was this something separate you wanted to talk about?
No.
I didn't say long-term care provision in this though. So let me pull up the other one. So I'm not sure. Okay. Well, here, I'll stop sharing that one. I'll pull up the other one then. That was actually a pretty interesting product. Your indexed annuity product that maybe we'll talk about. Maybe it might not be able to talk about today, but maybe at a later date. Let me cancel this real quick. All right, let me bring up the other one. Are you did you have a chance to? Why'd you get that illustration on the annuity?
Oh, that does have a long-term care multiplier on it.
Oh, the annuity did? I didn't see. Okay, yeah. Interesting. I see that. All right, but let's pull this one up then. Interesting. Because that actually looked pretty good, and I thought you might have sent that to me because I did a couple of videos on protecting the downside, and here's some ways to do that. On another video, we're going to get in deep into Amar's ability to do some put options and things of that nature, and other ways to protect. Maybe we should just do that next week, Amar. Just go into strategies to protect the downside. I'm actually even more concerned about a downside issue than we have. I'm more concerned about that right now than I was in a long time, frankly. Anyway, so maybe we can talk about that, and we can do that next week instead. Would that work for you, you think?
Sure. Yeah, let's.
All right, here we go.
We can talk about it
offline. You don't want to talk about with everybody watching. All right, so here we go. So we got a lifetime income plus multiplier flex. All right, so first, yeah, okay, I guess the same thing. All right, that's interesting. So fixed index annuity illustration prepared for the value client. All right, so again, this is just a sample. We're not going to go too deep into this. But what I want to show you here is I want to go down to, look, and if you buy this product, you can sit on the boat with the sun out there. Isn't that cool? They're never sitting there digging ditches when they buy these products, right? All right. So what we're going to do is we're going to go down to the, right here. All right. This is what we want. Can you see that? Let me see if I can't make this bigger. All right. There we go. All right. So this is Arizona, non-qualified, which means it's non-IRA money. All right. And so what's happening here is we have every single illustration is going to have a guaranteed amount. All right. So every single illustration say this is what we guarantee. So you always got to start with that. Then they're going to have all these different up here interest crediting strategies, point to point with spread on PIMCO, point to point with a Merrill Lynch, just all kinds of different spreads. I don't even want to get in that here today because it's way too there's too much to figure out. But we're going to say we have cap rate, that's participation rate, 100%, the cap rate, participation rate, cap rates. These are all the terminologies you got to understand. So we're going to go into this. Guaranteed retirement income. All right. So they're going to say, so we got a bunch of different things going on. It's a Swiss Army knife. Now, a Swiss Army knife in of itself isn't looked on as a bad thing. But sometimes when you're the jack of all the trades, you're the master of none. And that's not necessarily a bad thing, but just keep that in mind. If you're comparing a product that has a lot of different Swiss Army knife components to it, you can't say, well, that product sucks compared to this specific product, if that makes sense. You can't say that Swiss Army knife is bad because this one product that's geared towards chopping down wood is better. That's true. But the Swiss Army knife has a saw, but it's not the same as a freaking chainsaw. You just got to keep that in mind. And I think a lot of people, they like to do comparison like, oh, that's too many options, and neither option is the best in the business. All right. So anyway, so in this case, we're dumping in, we're putting in $300,000 is what we're dumping in here. Okay, so $300,000 is going to take it out as an income for life. And the guarantee here is they're saying if you wait until you're how old here? You're 65 years old, you'll be guaranteed to take $14,400 out. That's one guarantee. If you wait until you're 80 years old, you'll take $20,000 out. That's another guarantee. That's the worst case scenario based on the claims of paying ability of the insurance company. So what I do with that guarantee, I take my trusty calculator. Now, this is a guarantee for an income perspective, not necessarily a long-term care perspective. And we'll look into the long-term care provision here in a second. $14,400 divided by $300,000. That's going to be a 4.8% guaranteed payout, which in of itself isn't great, but it's actually not bad. That's not bad. Now, it's a 65-year-old person. It's going to be on one life. So we don't really want to do that because we could find other ways to get that a little bit better. But at the end of the day, going back to the Swiss Army analogy, that's actually not bad. That if you say, look, I don't think I'm going to need this for long-term care. I just need it for an income perspective. You're not getting rooked here from the annuity perspective, if that makes sense. It's not bad. It's not great, but given all the other bells and whistles that are in there, it's not bad. So that's the worst case scenario. So we're going to go down here, and we're going to see other illustrations. We got a hypothetical right here. And what's going to happen here is they're going to use their various index, what they got on the indexing on PIMCO, the Morgan, the Merrill Lynch, all these other things as well. And we're going to see that's – if I could show this, it's hard for me to see. I need my glasses. I'm getting old, Amar. But you'll see that in this case, you actually made some money in this year right here, the year two. All right, you made some money. You made some money. You made some money. Now, these are not guaranteed, but at the end of the time you're 80 years old, given that you made some money, you have $470,000 that is worth your contract value. It's neither good nor bad. It's just what it was. All right, so $470,000. Now, if you were to take an income stream off that would give you right there $48,000. So remember, with a guarantee, we're only getting a guarantee of at 80 years old. We go up here. We're saying we're getting a guarantee of $20,000. Not great. But it's not bad. However, in this case, if the markets did anything, and it might not, we don't know, but we know for a fact we're going to get no less than $30,000 a year. In this case, we got right there a guaranteed minimum with these market projections of $48,000 a year. So we have a floor of $30,000, and we'll say an upside of $48,000. That's not too shabby, and that's with all fees and everything. Now, all right, so let's keep going down here, and this is where it gets real crazy because all these interest, crediting, accumulation, value details. Look, at the end of the day, you recognize you're if you're buying these kind of products, the insurance company's making money. There's no other way around that. You're going to pay fees. I just cannot stress. You're not getting around that stuff. You're not going to be an S&P 500 index on the upside, but we're also going to have guaranteed protection on the down, which I like. I mean, that may or may not be good for you. It might not need it. I don't know. But all right, let's see. So let's keep going down to the long-term care stuff. Hold on just a second. And this is where it gets, let me just, we're going to go to long-term care. See, I didn't see the provisions on the long-term care stuff here, Mar. I just saw these were the income, but I didn't see anything on the long-term care. You sure?
Yeah, and so I just got this earlier today. Right. So I haven't had a chance to look at it, but it does have what it's called like a multiplier on the need of care. So I think how they, in this illustration, what they show is on the last column, the legacy component, the death benefit, that is how much you have access to. You can pull from that amount if you have a care event.
All right, so let's look. So you're saying this right here, the legacy death benefit. Yeah. Okay, so it's accelerated. Oh, all right, I see what you're saying. But okay, so let me look up the accelerated death benefit. All right. Accelerated. Okay, that's it. I don't like that. They don't. I'm not a fan of that if we're using it for long-term care. It's not very explicit, and I need it to be explicit. So what you're saying here is you got. I don't like that, man.
Let's just go back to our presentation.
Yeah, I'm not a fan of that at all. So I thought you were using that for an annuity because I said that's pretty good, but I don't like that. So real quick. Accelerated death benefit, my friends, is what that means is if you need if 2 of the 6 ADLs, the assisted daily living, if you can't do 2 of the 6, and the big one's transferring, literally getting up and rotating 90 degrees is transferring. If you can't do that, get them off the toilet. That's literally what it is. You can't get up off the chair. You can't get off the toilet. If you can't feed yourself, if you can't, just 6 activities of daily living, what Amar was saying. If you can't do 2 of those 6, you get access to that death benefit to some degree for long-term care. Now, I didn't see anything in either of those illustrations that said how much. So I'm hesitant to go down that road for this seminar. But My issue is the accelerated death benefit is a way you have access to your life insurance component without dying, which is kind of cool, man, because I got a $300,000 death benefit. I know in this case, I got $300,000 as a guaranteed minimum death benefit. A lot of times the accelerated death benefit, I get about 66% of that, essentially is what it is. So if I have a $300,000 death benefit, that's a life insurance component of the annuity or the life insurance. If I'm approved for 2 of the 6 ADLs that I can't do, I can tap into that accelerated death benefit, the death benefit, and take money out to protect me for long-term care before I die, if that makes sense. The drawback about these policies, there's so many bells and whistles, it's hard to follow through and understand what's going on. I mean, I looked at that. I looked at the first one. I said, I didn't say anything for long-term care. Don't get me wrong, Amar. That's the issue with these policies. They're confusing. However, you can't let the confusion sway you from saying, I can't ever do that because I don't understand it, because it could be some significant value there. Don't forget, secondly on that, there is a value added that you have an income stream that you can't outlive. And it's just a fact. Now, would I do that right now? No. I'm 50 years old. I'm accumulating into my portfolio. So I'm all VTI or bust. If I'm 65 years old, though, and I can't qualify for traditional long-term care policy because they're doggone expensive, and I have some money sitting on the side that I don't quite know what to do with, I'm nervous about the stock market, something like this is not a bad idea. It's not, because then you can cover income stream, potential for a little bit of upside growth, and potential for long-term care all in one. Neither is going to be the best benefit, but all three is a pretty good choice. Yeah, so you were saying, Amar, you want to bring back up that presentation?
Yeah, let's do that. And to your point, 37% of people that applied for long-term care between the ages of 65 and 69 were declined coverage.
Yeah, as long as you get more too, absolutely.
Yeah, so
the hard part I had when I sold my MoneyGuard policies, which is similar to this, what you just saw right there, but it didn't have an income guarantee like what these policies are doing. The hard part I had was that, all right, sweet, brought it back up, was they had to qualify for life insurance and they had to qualify for long-term care simultaneously. And remember, the insurance company risk to life insurance is that you die too soon. You die too soon. The insurance company risk to long-term care is that you live too long. And this is where these hybrids come a challenge and why they're not as great as some insurance purveyors would make it seem. Because if you die too fast on a life insurance policy, the insurance company's on the hook. They'll never make their money back. On a long-term care, if you live too long, the insurance company's on the hook because they'll never make their money back. And so they have two literally competing entities there with life insurance and long-term care contract. It is, Nancy. I might want to bring that back up. Marty, just
let's do it later.
Well, I want maybe when you're off, I'll bring it up and just kind of go over the annuity aspect of it, because I think there's some benefits there. But anyway, yeah, keep going. Let's keep going.
Vinyl Earthlink basically said you should buy an annuity that pays at age 85. Well, yeah, that's what a QLAC is, right? Yeah. So a QLAC is a qualified longevity annuity, which you can basically defer required minimum distributions to a later time period and then take extra income at that point. So that could work for that as well. So the last thing here, I mean, we'll end it on the last few slides. So you already talked about the life insurance with the rider, competing goals. So just be careful. And then there's a couple questions around costs. So a 60, if you apply as a couple, it's actually sometimes can be cheaper than if you apply independently. And so if you take a couple that's 60 years old, it's about $3,500. And for $150 a day benefit. And if you take a single 55-year-old male, it'd be about $1,800, and single 55-year-old female would be about $3,000.
No, that's discrimination, man.
Well, there's factors that influence the policy, and there's also different types of bells and whistles you can buy, but state that you buy the policy in, the health at the time that you buy the policy, and the time that you get it. And so another thing that I have here, I just went over that. So the benefits are both for all of these policies about $165,000.
All right, so let's ask a question. Is the insurance company discriminating against women by charging almost about 60% more? Is that discriminatory? So let's ask a question to the audience here. Is the insurance company hate women because they're charging that much more? All right, so say yes, the insurance company hates women, or say no, they don't. Let's see what we got. We need some engagement, my friends. Engagement helps the algorithm. So let's see what we got here, Amar. So thanks, Amar, for the cost factors. All right, so I'm saying the insurance company hates women because they charge more. That's what I'm going to say. So I'm speaking on behalf of everybody. That's right on. So the two ladies are out there. They know. The insurance company does not hate women. They're basing it on life expectancy. Exactly right, Denise. And that's the issue. The insurance company says, oh boy. I'm going to get rid of this guy. We got a guy we got to put in timeout. We got to block him because women live longer. That's 100% right. So it's shocking, but it's kind of like the pay gap. Insurance companies do like financially naive customers. That's true. Exactly. But that's not because women are financially naive. It's because women actually live a whole lot longer. In fact, what's the life expectancy for men has gone down to like 76 now. Now that's the baby being born today, but still women live longer than men. It's just a fact, man. Claudia says, we live longer. Oh, that's discriminatory, Claudia. That's just straight up wrong thing. All right. So what else we got on this here, Amar?
Nope, we're just open to questions now. All
right. So let's go back. Amar had a personal experience with long-term care himself. Now, did you say, Amar, that your pops had it, the long-term care?
Yeah, so my dad got a hip replacement surgery, and he ended up getting a blood clot during the surgery that then gave him a stroke. And so his recovery process from the hip replacement took a lot longer. Little things that we probably could have done by ourselves. Like, for example, like my parents have a step up to their front door, right? Like it's a one step. And, you know, the long-term care policy came in and said, well, you need a ramp there because you can't get up there. And they list a bunch of things that my parents needed to do, and they paid for it. And we had a California partnership policy. So the person that came in to say the things that my parents needed was not the insurance company. It was a third-party company through the state that said that these are the things that needed to be paid out and got done. And so it was great. My dad was at home. My mom, it was easy for my mom. There was somebody that came in to help my dad a couple hours a day, and then my dad eventually recovered. You know, so it was good.
And how much did it cost? All said and done.
The policy?
Well, like for everything, like I mean, how was
I don't know. I mean, the insurance company paid for all this stuff.
That's what I'm saying. So at the end of the day, he was covered with the insurance company.
Oh yeah. So like it was with zero out of pocket from my parents, right? That or I shouldn't say zero out of pocket because they paid for the insurance policy.
Looks like we're buffering. We buffering. I can still hear you, Amar, but I just got an email from StreamYards that says they're having a hard time with YouTube. It might be on YouTube. All right. Looks like. All right. So Nancy says it looks like we're buffering for a little bit. Yeah, we're right on. Okay. All right. Yes, that's weird. Looks like we're back. All right. So
the partnership policies, right? Like the ones that my dad had, essentially they're sold to help protect more of your assets, right? So if you have a policy that has, let's say, a total benefit of $500,000, then you can protect $500,000 of your assets from being spent down before the state steps in.
Nancy says, do you need a physical before you get into these policies? Absolutely, Nancy. Long-term care is tough to, like Amar said, about the people who don't get approved. And now remember, the folks who are applying is a self-selected group anyway. Always remember that about insurance. No one applies. I mean, you're not going to go try to get fire insurance when your house is on fire. You see what I'm saying? So you're always going to get it in advance of that happening. But a lot of people say, I'll wait. This is the whole thing with the whole Obamacare stuff and the whole debacle with existing conditions and whatnot. The facts are people who have illnesses are the ones more prone to be an expense to the insurance companies. And the insurance companies aren't stupid. They know that. This is why the Obamacare mandate, which I think Biden's trying to bring back in, by the way, I think he might have actually brought it back in, is necessary. As evil as it is, it's necessary because insurance, a lot of healthy people don't pay because they don't feel that they are at risk for needing insurance. The people who are sick, thus, get to have to pay more of the premium because they're the ones who are going to use the policy. It's just that fact. So Obama, when he did the Obamacare stuff, he says, we're going to mandate the healthier pay for the sick. It's just subsidizing. And that's what the insurance mandate was. Now, it doesn't matter like it, but like or love it. At the end of the day, what happens with these policies is that the insurance company says, hey, I'm going to be on the hook. I'm going to get something over here. I'm going to be on the hook for paying for Nancy's coverage. And Nancy's only going to apply for a policy because she's in a world of hurt. She's not going to apply for a policy because she's financial or good health status. And so because she's not going to apply, if you're in good health status, most likely, they're going to underwrite you to make sure they're not on the hook for some significant risk. So that's how it works. And and even with that said, still a third of the people get denied. It's crazy. And I bet it's even more than that now. I think Amar's thing was back from 2015, right, Amar?
Yeah, in terms of the denial rate?
Yes, exactly. Yeah. All right. Partners. Hold on a second. There's partnership policies almost every state. I know that. So the partnership that was okay. I'm not the hugest. I don't think it's that big of a deal, but I know a lot of states have partnership policies. That's for sure. What factors come into getting long-term care? What do you mean, what do you mean, James, like in terms of what you should be considering for you to get it, or what is the insurance company considering? All right, Amar, here's one for you while we're waiting for James to follow up there. Yeah, we're butting. That's weird. What is retirement income threshold to self-fund? Pensions and Social Security with COLAs? What would you want to answer that, Amar?
Yeah, I mean, that is a personal it varies person to person, right? But if your assets can spend to if you're wanting to self-insure and spend down your assets, then you should carve out the amount of need for care. So the average, I'm going to give you some numbers here, so you can use this to kind of self-calculate how much you should have set aside for cost of care. So the average duration for a female using long-term care was 3.7 years. The average duration for males was 2.2 years. Now, I guess
that's average.
Yeah, and so if you use that and you use the cost of care, you can figure out what that dollar amount would be that you would need to pay for. And if you have pensions, you can see if those pensions would cover that. If you don't have pension, you could discount that to get a present value of that, what that's worth today, and then figure out if you have that, saved up to pay for it.
Let me go in the other room because loudmouth over there. Hold on just a second. All right, hold on a second. And remember. All right, there we go. We got loudmouth. Oh, loudmouth. All right, so James, what is the insurance company looking for? All right, so that's what James asks. James, the insurance company just wants to make sure they can make money off you, man. That's what they're looking for. So when they issue you a policy, altruistic, that's what doggone it. They do it because they want to say, hey, we're willing to provide you protection, but we're going to make sure that we can. We're not going to take it on the chin, if that makes sense. So
yeah, it's pooled risk, right? So like some people will use the care, some people won't use the care. In fact, I think if you're 65 today, it's about 70% of the people who are turning 65 will need some type of care. So what they're trying to do is calculate, all right, with this, how many people will need care, how many people won't need care. the people that need care, how long will they need care for? They average that cost, and then they get it per policy expense, right? And so they're in it to make money, like you said, Josh.
Well, they have to. I mean, that's the thing of what I think insurance companies, they did very well in the Great Depression. Banks are going under left and right. Insurance companies were not, because insurance companies know the minute people doubt the ability of the claims paying ability of insurance company, they're not going to buy the product, because insurance companies based on just your hope. Essentially, you're saying, I hope these guys are still in existence when I die, because if they're not, my wife is going to be destitute without my life insurance. No. And so insurance is based on your faith that the insurance company is going to be there, which means they have to be conservative in their underwriting. So James, you might say, hey, James, we see you like to smoke cigarettes, huh? Yeah. I'm going to have to, Mar, I'm going to go get, you keep talking and get these dogs. Yeah. All right, hold on. I'll be right back.
Yeah. So I'll try to go through some of the questions that's in the comments. So I can't type in the thing because it's through Josh's channel. But so one of the things that struck me as interesting here is that 68% of people that stay in a long-term care facility are women. And we talked about that women are typically the caregivers, and therefore, so for most individuals, if you want to stay in your home, right, you're going to have to probably make some improvements to your house to make that possible, right? So as we get older, we need more help. So some of the things is where things are placed in the kitchen. If you have stairs, getting up and down those stairs, if you need help, if you have access to, like, how are you going to get that help if you need it, like on a day-to-day basis? Those are some things that you should be planning for. So even if you're self-insuring, you could still make how do I make staying in my existing house for as long as possible that potential to go higher, right? To stay in your own home.
Absolutely. All right, so let's see what else we got. Just want to protect my wife. Right on. That's why I got it too, James. I just want to make sure that Charlotte is not destitute if something were to happen to me. So I have long-term care and I get a boatload of life insurance, which makes me kind of scary because my wife is like, shiv, because I'm a lot more worth, a lot more dead than I am alive. If that makes sense. Indiana partnership were astronomical even 10 years ago. Even my sales agent says not to get it. Yeah, we were doing long-term care seminars, me and this guy named Pete in New York, all up and down the state of New York. Hell, that was freaking 10 years ago. And it was crazy back then. And it's only gotten worse now, man.
But, I think the partnership helps a specific group of people, right? Like all these bells and whistles are to solve a need for a specific group of people. So it may not be what you need, right? But I think the partnership does serve a need. Let's say from a portfolio standpoint, like if the cost to get partnership versus the withdrawal rate on a portfolio for the cost of care, and leaving a legacy, it was important to you. You could find a break-even point there.
Yep. 100%. And I'm not against long-term care, at least looking at it. I find it to be way oversold in terms of that making people scared. You hear this stuff from Fidelity, which friggin' ticks me off. Oh my goodness, you need $315,000 to cover your medical expenses when you retire, and that's not even with long-term care. It's such a friggin' scam, man. It's such a scam, and I hate it. It's because they're literally preying off the fear of ignorance. They're saying, oh, I need $315,000 for a married couple who's 65, and that doesn't cover long-term care. Then you throw long-term care. I better keep working and digging ditches and saving and not spending. And it's all fake news. It's all fake news because what they're not telling you, my friends, how much does it cost to feed yourself over the course of your 30-year retirement? If we had a lump sum that today, how much would that be? All right, that would be $700,000. How much does it cost for transportation? How much does it cost for property taxes? How much does it cost for your house? How much does it cost for living, just basic living? Any of these lump sum things that they use to scare the living bejesus out of people, we can make it seem like it's going to cost you $250,000 today, to cover for the next 30 years of your life. It's fake. It's just bullcrap because they're trying to scare the living bejesus out of people, and it works. It works. I'll do it. I've done videos before. I'll do it again. Is there a place to look up what 3.7 years of care would cost on an average per state? Oh yeah, well, I don't know. Mars, Genworth. I mean, I'm not sure. Are they still doing this?
You can go to the websites, but instead of doing that, go to a place that provides care and figure out how much that they're charging today, right, for the cost of care, and then you get an accurate, number for a place that you would consider. I think visiting the facilities in your local neighborhood or where you would be next to children, grandchildren, whatever, is a good way to get accurate pricing.
We didn't talk about it, but I'm a big fan of CCRCs, Continuing Care Retirement Communities. So I'm a big fan of CCRCs. We don't have enough time to get into it today. Amar, it's do you need to get off at 12? 1:30?
Yeah, I'm going to hop off here. Yeah.
All right, good. Thanks for being here. So Amar will be here next week, but not the week after. All right, so next week.
Oh, no. So I'm going camping the 28th through the 4th. So on the 31st, I won't be here.
Yeah, so that the week after next. Yeah, okay, got it.
Yeah, okay,
yeah. Cool. All right, so thanks, Amar. I'll call you later. All right, thanks, bud. All right, so what I want to do is I want to go over this. I was trying to find real quick. I was trying to find on the hold on just a second, because I want to show the state of New York, the second highest. Geez Louise. The second highest expenditure on the state of New York is long-term care costs and nursing home costs. The second highest expenditure in the state of New York is long-term care and nursing home costs. And so what happens is, which is one of the reasons why Governor Grandma Cuomo, was very keen on getting people who had COVID into nursing homes, because he knew where the second highest cost of his government was. It's in nursing homes. Number one is public education. Number two is nursing homes, Medicaid. So remember, Medicaid is run by the state, all right? The state runs Medicaid, and there's no money for Medicaid. Medicaid and Medicare are bankrupt. I'm going to do another video. I'll do a video later on today showing you what an IRMA guy got an IRMA receipt from the Social Security Administration that says you got to owe more money for IRMA for Medicare. I'm going to show you exactly what that looks like. Medicaid is run by the states. Medicaid provides for nursing home coverage. Medicaid does what some folks said here is with a partnership, we'll have the state kick in to protect your assets and all that. States aren't stupid, man. They know they don't have the money for this stuff, and they know if you have the money for it, they're going to come after you. So Cuomo is freaking scumbag. Yeah, right. Well, Medicaid, and so you think about New York. All right, is New York a net recipient of taxes or a net payer? I mean, literally, the issue with the blue states is they pay more than they get back to the federal government. The red states get more back than they pay, which is kind of ironic. So the blue states pay more than they get back. So Medicaid is funded by half the feds and half the state. When the feds create Obamacare, more and more exposure for the states to jump on the Medicaid bandwagon, which is what they do under freaking Obamacare, and idiots like John Kasich fell for it. Essentially, Obama said, we are going to pay for, I think it was 80% of the expansion of Medicaid for the first couple of years. And John Kasich says, sweet. And then what he did, he said, after 3 to 4 years, Kasich, you'll be gone from office, and then it's going to be on you, baby. You're going to have to pay for the expansion of Medicaid that you promised. It's freaking idiotic, man. And idiots like Kasich should have known better. But, they like the power. They love being sweated by Obama. And, they love being go to White House. Like, come here, John Kasich. We love you. And he's like, oh, yeah, I'm hanging out with Obama. This is great. They're fools. I get it. But anyway, Medicaid is a big scam, man. No other way around that. The federal government dictates and the states implement. All right, but I want to go back to this, and I'm going to I'll do another video on New York budget when it comes to Medicaid, because it's ugly. I want to go into this annuity thing, and this I didn't expect Amar was going to need one. I didn't know this was a long-term care one. I didn't see the long-term care, but I like this a lot in some regard. I'm not the biggest fan of annuities, but I'm not a negative. I'm agnostic about annuities, that's for sure. So this is, I don't even know what the company, North American, I don't know what this is. But I want to show you how this works. I actually liked it in some regard, and I think it is overlooked a lot because, as we talked about earlier yesterday, I did a video talking about the Swan Defined Risk program that they have. You're buying insurance to protect you. That's what insurance does, protects you. No other way around that. It's not a wasted amount of money if the insurance never comes to fruition. Again, going back to the house burning down. I have homeowners insurance to protect me from fire. If the fire never happens, then has that been a waste? No, it hasn't been a waste. It's provided me a peace of mind knowing that if my house burns down, I'm covered. And that's what long-term care does for me. I mean, at the end of the day, I don't like paying these premiums, but every year I pay is one more year. It's okay, at least I'm covered for the next year. And then after the next year, I can always stop if I want. That's what insurance is. You're paying money to protect you. No other way around that. So anytime you're doing some kind of downside protection, you're taking some kind of insurance component, be it through I'm hedging, i.e. I'm buying put options against the S&P 500 like the Swan did. I'm limiting my upside, which is what some of these index annuities do. I'm buying bonds. Bonds inherently have less upside because they're bonds, for heaven's sake. Bonds have some downside risk, but the insurance is I'm sacrificing some upside for a protection against the down. And if I'm about to retire, I think that's a pretty important thing to do. Now, the drawback about annuities is, well, I think I'll show you here is right here, surrender charges. I mean, my goodness, 10, 10, 10, 10. I mean, look at that, 10%, 10%, 10%, 10%, 10%. So you're limited on how much money you have access to without a significant surrender charge. So you got to be careful. Now, there's a huge benefit on these surrender charges that I think gets overlooked. That means most people won't touch this. So most people will let the contract do what it's designed to do, which is to work on the background while you're pretending it's out of sight. Is basically out of sight, out of mind. Problem that we have right now, short-term trading, unlimited access, easy access to your portfolio is a losing strategy for long-term growth. It just is. Because you're like, oh, I could sell, I could buy, I could sell, I could buy. No one ever thinks about that with a house, because the cost of the surrender charge of selling your home is too high. No one ever thinks about with annuities because the surrender charge. There's a huge benefit to having a surrender charge. I'm just telling you right now. It's not a huge benefit if you need that money liquid, though. It's FYI. And as always, all surrender values, all annuities give you one. Usually they give you these guys give you a penalty-free up to 7% of your beginning of your accumulation value. So most with 10%, they give you 7%. So there is always, you have access to a little bit of the money, but after that, you still have to pay a surrender charge. But I want to show you how this works. I looked at this pretty deep, and I like this one a lot. I didn't see anything on long-term care, so I wasn't sure why that guy gave this to Amar for long-term care. I was confused by that. But all right, so you got all these different projections. You got, hold on a second, right here. And I'm really point to point with participation rate, crediting rate, point to point with enhanced participation rate, subject to strategy fee. You got, let's see, 2-year point to point with enhanced participation rate, subject to strategy fee, 2-year point to point. So you got to choose all these things when you buy the contract. I'm not going to get into it right now. I want to kind of show you just the bare bones on how these index annuities work. And why I'm kind of keen on them, man. Again, I'm not keen on like you should go do it, but I am keen on to say there are strategies out there as opposed to taking a 54% drawdown in the S&P 500 a la 2007 to 2009. All right, so basically what's going to go on here, we're just going to go down to the illustration itself. Now, this was pretty interesting. All right, so here, this is, we kind of talked about that when I was looking at the other scenario. If you are 65 years old, all right, and you were to take a lifetime distribution amount out of this policy, you get 4.5% would be what you could get out. So if you're 65 years old, you get 4.5. That's on a single life payment. It's not on a joint. In fact, if it's a joint, it's going to be 50 basis points reduced for a husband and wife. So again, if you had $100,000 in here and you're 65 years old and you're single, you'd be able to pull $4,500 a month a year for the rest of your life, guaranteed. Hope that makes sense. Now, if you're willing to say, I want to increase with a certain rate, i.e. inflationary, maybe it can grow with the markets, you'd only be able to take 3.9%. All right. So you say, I'm only going to take 3,900, but I have a chance for it to grow as opposed to being flat 4,500. All right, that's not a bad distribution yield. It's not a distribution yield, it's a distribution payout percentage. on either. It's not great. It's just not bad. That's not a deal breaker to me, because there is some other assurances on these annuities. But just remember that. So it's based on how much you get from an annuity is based on the year you decide to turn on the income stream. If I wait till I'm 70, I can take $5,000 a year for every $100,000 I had put in there. Right? And the reason it gets more as you age, because you're closer to death. Insurance company says Josh at 70 is less likely to live long than Josh at 65, which is much less likely to live long than Josh at 50. So just remember that. The older that you are, the more you can turn on for a guaranteed income stream. All right. So let's go down here. So here we're doing the S&P 500 enhanced roll up 2% point to point. That's freaking nuts. But I mean, just because so many things, like, how can I figure this out? So let's bring this up a little bit more. Here's our guaranteed contract values. I don't see any questions coming out. I just don't see it. So I'm just going to go through this real quick, and then we'll answer any questions that you have. I don't sell these. So I get no pay. Amar doesn't pay me. He sells them, but he doesn't get a commission. He gets a fee on it. Well, I don't know how he gets paid on them, but I don't sell these, just FYI. So I have nothing to sell you, and I don't care if you buy it or not. I just want to point out to you. All right, so we got $300,000 is what we're putting in. We're 65 years old today. We're putting in $300,000. Why are we doing this? Because maybe we've got some nice gains on the table. We want to lock them in. All right, so maybe we started with $500,000 in the S&P 500. It's worth $1 million now. We're going to take $300,000 off the table, lock it into a portfolio that can't lose and still have some upside. Hope that makes sense. All right, so the minimum guarantee surrender value, that's how much I have access to. That's my walk-away money. This is my walk-away money. When I tell these guys to go pound sand, cut me a check, the minimum money I have in the first year is less than the amount I put in. Why? Because of surrender charge. After year 10, the minimum amount I have is $300,000. That's the minimum guarantee. So I'm guaranteed in year 10 to get all my money back. Guaranteed. So that's kind of like a return of principal, if you will. All right. Now, you're not making, but you're guaranteed to get no less than your amount you put in. There's something, I think, valuable to know that the worst case scenario, you'll get what you put back in. Now, it is after 10 years, I grant you. Now, what happens is after year 20, if I make no money right here, well, I shouldn't say make no money. If I don't make that much money, I'm only guaranteed to get $320. So after year 20, I'm guaranteed to get my money back plus $20,000. Not a huge benefit, but it is what it is. I'm getting my money back plus a little bit. What's that? 0.5% I think is the interest rates on that. So that's, we're going to get more than the guaranteed minimum, but there is a guaranteed minimum, which is nice. Now check this out. These are, if I make no interest, what's my benefit base floor and my benefit base? This is where let's go this year 10. All right, so I am guaranteed, all right, right there, benefit base. All right, this is where it gets, I love this. This is where it gets fun. I don't love to let you go buy it. I'm not saying that. But this is what I enjoy about these annuities, because I think a lot of people don't understand them. And then fools who sell these people, who are just, the insurance industry fools who try to sell this stuff to people who are ignorant about it, I can quickly poke holes in it and say, this is the benefit base of how much income I can get from this on a regular basis. It is not my walk-away money. Walk-away money is how much I get a check and walk away from the stupid contract. That's not the benefit base. The benefit base is a roll-up. It says every year you're going to get a certain amount. I think this was 5% is what it was. I think I saw 5% someplace in here. Yeah, 5% roll-up right there. So what this says is every year I'm going to get 5% more as an income stream than I did the previous year. So two things happen here, two completely different things. This is the amount of money after 10 years I'm guaranteed to walk away with, this minimum guarantee surrender right there. That is the guaranteed minimum I can walk away with. This is the guaranteed minimum for which I can take an income stream off. So what happens here? Remember, now I am 70, we'll just say 75 years old. 75. I started by 65. I'm 75 years old. I'm guaranteed to get $18,000 off that account. How's that money being derived? Well, if you go back to this right here, it'll tell us how much we could pull. When I'm 75 years old, I can pull 5.5% as a level benefit, fixed for the rest of my life. 5.5%. So we come down here, we say, okay, I'm 75 years old. My guaranteed minimum at 75 years old is 331,000. So I take my trusty calculator, and I say 331 times 0.055 equals right about there, $18,000. That's about a 5.5% guaranteed lifetime payment amount. Guaranteed, never go down. It might never go up. In fact, it probably won't, but it could in theory. It probably won't, but it might never go down ever. Now, once I start taking this income, my friends, let's just make sure you all can see this. All right, yeah, sweet. Once I start taking this income stream, this right here reduces the guaranteed surrender value I have, right? So if I'm not making any money in this contract and I'm pulling 18,000 a year off, and I just say I got zero interest for the rest of the time, this will $300,000 by divide by 18,000 will last 16.6 years before this surrender value is zeroed. Now, if this surrender value goes to zero and I'm still alive, do I still get this 18,000 a year or whatever it was? The answer is unequivocally. So even if the surrender value goes down to zero, I still have 18,000 a year coming in. I hope that makes sense. That's a big deal because it's not contingent anymore on the market value. Now, look, we're taking $18,000 a year off a portfolio that's worth $300,000. That's a 6% distribution yield. That money won't last very long, most likely. And because it won't, this surrender value will probably go to zero before I die. That means two things are going to happen. I won't leave anything to my heirs here. That money will be gone because it'll be zeroed out by the time I die. And though I also get $18,000 or $1,500 a month for the rest of my life. Hope that makes sense. So that's pretty cool. All right, now they got this LPA multiplier. I'm not exactly sure what that is. Actually, I didn't take the time. It's a lifetime payment amount. I don't know what that is. I didn't take the time to look into that. That might have something to do with Amar's long-term care thing, but I didn't see anything about long-term care. So I'm cautious to go into what this illustration says about long-term care. They're also saying if you die right here, you can take your death benefit over 5 years at 66 a year for 5 years. I don't know why anyone would do that, but in theory you could. All right, so at the end of the day, we say, okay, that's with a 0% rate of return. That's zero. Effective annual rate is zero. Essentially, I'm losing money because the fees and all that. What if I got even a decent rate of return? And here we're going to go to a 5.43, and that's probably the best you can expect to get in these kind of contracts because they're so heavy on fees. All right, so what if I get 5.43? So I just showed you zero. I was getting worst case scenario, all my money back in 10 years or $18,000 a year on a $300,000 investment. That's the worst case scenario. And look, we can even say this is a best case scenario, if you will. At 5.43, that's net. All right. So best case scenario is my debt, my surrender value, my walk away money is $466,000. 466. That's the amount of money I can walk away with. Say, you guys, I'm out of here. I'm getting 466. Now, notice I didn't make any money there. I didn't make any money here. I didn't make any money here. I didn't make any money here. And I didn't make any money here. Why? So let's see if anyone, why do I got zero crediting rate, but I got big crediting rates these other years? If anyone's still here, not many people. Let's see why you, all right. Let's see. Why do I got no crediting rate there? No interest rate. Anyone want to? I hope I'm not still buffering. Yeah. I'm just going to do this and hopefully that this will record so I can put it up there. Maybe I'll do a separate video just on this alone. Anybody? Anybody? I know we're 15-second delay. Yeah, I'm not sure what's going on, man. Maybe it's just buffering. Maybe y'all can't see it. It was buffering before. What's going on? Okay. There's Nancy's still here. Okay, cool. Exactly. Jill makes my 6.1% that started at age 56 seem out of that world. That's what I was telling you. Exactly. All right. So, okay, good. Nancy, Denise, right on. No idea. That's fine. I appreciate you having the guts to say that, because the markets went down these years. So what's happening is when the markets go down, obviously you don't make any money, but you don't lose money. You don't lose money. Now the next year, let's see if it gives us performance. But so the next year, the market probably went up significantly more than this. I'm talking about, I can't remember what the participation rate and the cap rate was. I can't remember. I think it was 100% participation rate at 65% cap. We'll look at that. But anyway, the markets went up the following year. The markets went down this year. They went up. They went down. They went up. They went down. This is not what the market did. I guarantee you the market did more than this. But because you didn't take the losses, you still got some of the wins. That's a pretty big deal when it comes to retirement. I'm telling you right now. So I guarantee the market did better than this. I just got to see real quick if we can see what the returns were. Yeah. Does it tell us what the doesn't shoot? Okay, the chart illustrates value for the most recent, most favorable. Okay, so most recent. Okay, cool. So in when was this? I'm assuming this is 2020. What did the S&P 500 do in 2020? Hold on just a second. Let's see what the S&P 500 did. So we'll compare these together, shall we? Oh, I love this stuff, man. You guys probably think this is stupid. And Josh is lost off the rocker. I love this stuff. I always wanted to do this for a living, just to be able to freaking dive into these things and just share what my findings were. But I couldn't when I was working at a firm. It says, "Oh, you can't shoot there. There's no complaints approved." There we go. All right. Oh, sweet. Yay. Oh man. All right. So check it out. This is going back to 2019. 2019. This gave us a 25% rate of return. In 2000, I'm assuming that's the case. In 2019, the market was up 31%. No, wait, you guys can't see that. I got to share that other screen with you. Now, again, I don't have access to, I don't sell this. I don't have access to the inner workings of this. I'm just going off my observations. So just be advised. I'm not saying you should buy it. I'm saying you shouldn't buy it. Just, whatever. So 2019, here's the S&P 500 is up 31.33%. If we go back to, then 2018 was down, right? 2019 was up, 2018 was down. If we go back to the illustration, and we say, hey, 2019 it was up. Remember, the S&P 500 is up 33%. We're up 25%. So if we look at, and I'm not exactly sure what the crediting rate is and all that. But I'm just saying that gave us 75% of the S&P 500. I hope that makes sense. 2018, we were down. The S&P 500 was down. We weren't down. 2017, the market was up. How much was the market up in 2021%? And we were up 7%. So again, it's not obviously all based on the S&P 500. I don't know what it's based on. 2019, 18, 17, 16, the market was, the S&P 500 was up 1.25. And but after fees, it was down. So you can see how that works. But anyway, we're getting a portion of the S&P 500 or a portion of some investment. Actually, let's see what we're using here. They told us the investment. Hold on a second. I saw it. That's not what I want to see. They were using, I think they saw the very beginning. No. Nope. 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 Right here. Nope. The S&P MARC, multi-asset risk control. All right, so they were using some mixed portfolio, not just the S&P, but multi-asset risk control. And what we're going to do is we're going to make this smaller, and we're going to go down and see if we can find what the hell that is. The multi-asset risk control. So what does that consider? We go all the way down the bottom, and we're going to bring this back up. And we're going to say, what the hell is a multi-asset risk control? It's a broad fund of some sort. But what? We go make it. Right. Okay. S&P Vault right here. All right. The S&P. Let me make this bigger for y'all to see. The S&P 500 multi-asset risk control excess return is managed to a volatility target. As a result of the index performance will not match the performance of any other index of the markets in general. It has been in existence since 2007. Oh, so we don't have that much time to look at it. You rat Phoenix. I don't like that stupid multi-asset risk control. All right, let's keep going. I don't like it if it's only been around for freaking 3 years. Man, give me a break. Be it as it may. Let's keep going. This is fun. So much fun. I'm like a freaking child at Christmas time, man, looking at this stuff. I love looking under the hoods of this. Trust me, I can't fix anything. I can't put together crap. I like to garden. I have a brownish green thumb, but I'm not good at anything. But I love looking at this stuff because that is just weird like me. All right, so let's look. So we got. All right, that was at 0. Yeah, right there. All right, sweet. So if we got the multi-asset risk control thing, and that means we're getting 5.43 is our average effective rate. What we're going to do here is we made no money the years went down, but we made money the years went up. Sometimes it wasn't much, sometimes it wasn't much, sometimes it was a good amount. So right there, we can walk away with 466,000 schmackes. That means dollars in Maine language. That'd be Manglish, not Manglish. Maine speaks French, Canadian, English. So whatever that is. I'm not sure what that'd be. So in Maine language, that'd be schmackes. $466,000 compared to making no money, which is $300,000. So we can say, oh, that guy, Amar, he sold me a crappy product. I'm out of here. I'm walking away and I'm taking my 466. Conversely, we could take income. Look at that, man. So that is our walkaway money. That is the roll-up they gave us. And so our benefit base is 688 amigos. That's Spanish for friends. In the male, they don't do, no Latin American person ever says Latinx, whatever the hell it's called. No one ever does that. Only professors, high-fluent professors in Ivy League schools say Latinx. No one else does that. It's silly. Hey, Mr. freaking Guatemalan, freaking hardcore worker who's digging ditches. Are you, how do you identify your pronouns? Not one guy from Guatemala has ever said that. That has never happened in the history of mankind. All right, so in this case, we got 220,000 is our benefit base on top of what we already have as a walk away, which means our benefit base is $688,000. Remember, when we were 75 years old, our amount payout was 5.5%. So here's 37,000 schmackes. So we take our trusty calculator, we divide 30, we'll just say 38,000 divided by 688. That's 5.5% guaranteed. If that's an income stream. Now, Amar says there's a long-term care thing. It has something to do with LPA. I don't know what it is. Or you could take a death benefit. If you want to pay out that death benefit, $137 a year, we'll just do 137 times. And again, I don't know why anyone would do that, but let's just see what we got. That's not bad, man. That's $822,000. Wow. Actually, I see why someone would do that. So there's a lot going on here, man. But Josh, the fees. Well, hell's bells. Yeah, it's the fees. But there's a lot going on of benefits. We know what the minimum guarantee is, but there's more than that potentially. Might not be. But I'm sitting there, I'm thinking, all right, what is the risks that we have to contend with? Let me just look up what LPA stands for, by the way. LPA, I have no idea. Lifetime payment amount. All right. Once elected, this is amount that may be received each contract year for the life of the covered person, your old buddy Josh, even if the accumulation value is reduced to zero. When you first elect the lifetime income payments, you have the option between level or increasing payments, known as participating payments. If you elect increasing, your payments will increase by 100% of the weighted average interest credited. Your payments will be the applicable lifetime percentage multiplied by the... All right, so I guess if you elect increasing, your payments will increase by 100% of the weighted average interest crediting percentage. Your payments will be the applicable lifetime payment percentage multiplied by the greater of the current benefit base or the base benefit floor. So lifetime payment percent. Ooh, there's that's the ADL. Oh, I thought it was American Disabilities Act thing. That is the long-term care stuff right here. Oh, sweet. The LPA ADL multiplier will depend on the income you have selected and whether the payments are based on one or two persons. You are able to elect the LPA multiplier when the covered person cannot perform two of the activities that David. Okay. The benefit becomes available at the beginning of the third contract year and 6 months after the LPA has been elected. The benefit is not available after the accumulation has been, okay. Ooh. So once you start pulling money out and you have no money left, you can't get a long-term care rider. It may not exceed 5 years. Payments will not be available. Okay. LPA ADLs. All right. So a couple things. We got to find LPP. So is this the LPP right here? Yay. Okay, sweet. So remember, LPP, if we're 75 years old, you get 5.5%. I'm talking out loud here kind of to myself, so I'm not making any sense. Just freaking hang up and never come back. I'm sorry. I'm kind of, believe it or not, these videos help me figure this out. So the next videos I do will be better. I'm just telling you right now. I love it. All right, so 75 years old, the lifetime payment percentage is 5.5% if I don't choose increasing. All right, now, if I choose increasing, that is called the LPA, which was, what did I do with it? Right there, lifetime payment amount. All right, so the lifetime payment amount will be the lifetime percentage amount multiplied by the greater of the current benefit base or the benefit base floor. Okay, multiplied by the greater of the current. Okay, so good. So let's minimize this a little bit. I get what's going on, which is kind of scary. All right, even this old lump of coal can figure this out, I think. So we know what I'm 75 years old. We know for a fact what my benefit base is going to be. All right, my benefit base is this right here. But they're going to say that's the base roll-up amount, and they're going to give me 100% of that. So it sounds like I'm hoping this times 2 is that. Let's see. So 37,891. I'm hoping times 2 equals 75,781 times 2. Oh, it does. Yay. Ooh, take that, stupid insurance company. Take that, Amar. Take that. You know Amar's still watching. Yeah, we got it. So the LPA multiplier, we get 100%. So that would tell me then up here, if we got no interest rate return, it shouldn't be anything, right? Oh, but no, it's the greater of 100 times the lifetime payment. Okay, why would you not take the increasing? I don't get it. All right, so that's the benefit base, 5.5% times that, which is that. It's 100. Yeah, it's 100% of that. Why would you not take the multiplier? Man, I don't get it. All right, so anyway, and then we get that. Where's the ADL benefit? Where's for the long-term care stuff? And I'll answer some questions here in just a second, if anyone's still with me. Okay. You are okay. All right. The benefit becomes available at the beginning of the third contract here. Is not okay. Well, the LPL is multiplied by the LPAL ADL multiplier when the ADL benefit qualification. Where the hell is the ADL multiplier? Well, we saw what the LPA multiplier was. Well, I don't get it. So you are able to elect the ADL multiplier when the covered person cannot perform 2 of the 6 activities of daily living. The LPA ADL multiplier will depend on the income you have, whether payments are based on. So would it be? It doesn't say what the ADL multiplier is. So is it just this right here? I guess it is. It says LPA. Is that the ADL multiplier too? So in this case, I'm getting $75,000 a year for long-term care, I assume. That's still pretty good, man. That's only 5.43%. All right. Anyway, all right. I'm keen on that, my friends. Highest index growth from 2001 to 2011. Really? Wow. Lowest is from 2008 to 2018. Oh. So the lowest was 5.23. Wow. All right. So let's yeah, no one's here. Hey, I'll do this if I'm the only person here. All right. Well, if you're talking about deferred annuity, Jill, you don't include it in your net worth because it's just an income stream. It's like you don't include Social Security in your net worth. If it's a deferred annuity, I mean, if it's a deferred annuity, you do. If it's an income annuity, a pension, you don't. Hope that makes sense. Sue says, I know nothing about annuities. When you take distributions, it's ordinary income. Yes, ma'am. Annuities are taxed as ordinary income. Yes, ma'am. Absolutely. What's with the bluff? Oh, actually, I don't know what the bluff is. Okay. All right. I put value. I have an annuity or two. I put a value on the current dollar amount I would need to buy an annuity. That makes sense. But it makes sense, but because there's nothing there as an estate, unless you have a period certain that says, but most people don't. So I wouldn't, if I have an income annuity, I don't consider that part of my net worth. I consider that part of my cash flow. Hope that makes sense. All right. I'm going to do another video just on this alone, man. Condo guy says, take the Jackson perspective, variable annuity. Okay. And I 100% agree with this, Alberto. Al and his better half, they say only 5% of the people get affected. Why insure against something that's not? I completely agree. That's why I say just self-insure for most people. Now, again, it depends on the situation, but generally speaking, I'm not that bottom line up front. Okay. Bottom line up front. Oh yeah, the drawback, and remember, it's always. Oh, actually, hold on a second, Sue. We'll revisit this. Remember, with a non-qualified annuity, a non-IRA annuity, it's always LIFO, last in, first out. So your interest comes out first, which is taxed as ordinary income. Your principal is tax-free. You've already paid tax on that. Just keep that in mind. You put $100,000 into an annuity. It grows to $120,000. That $20,000 is the first money that goes out, and you're going to pay ordinary income tax on that. I hope that makes sense. The rest that come out is tax-free because you already paid tax. It's already been taxed. All right. Bottom line up front. Bottom line up front is you shouldn't walk away from here, Jeremy. I don't care what your stupid boss says. Tell your boss to pound sand. All right. Say, hey, I'm on a live stream with Josh on the company dime. All right, my friends, I think I get out of here. I want to look into this a little bit more because I actually I'm just interested in these things because I think there's some benefit. Yeah, so let me just share with you real quick. You may or may not know what it's like to deal with retirees in the aughts. It friggin' sucked, man. It sucked. I'm just telling you right now. People's money is just, we didn't know. No one knew. See, that's the thing. In hindsight, that's what drives me up the wall. Everyone's like, in hindsight. Well, hindsight, schmindsight. You didn't know that the market on March 9th was at the bottom. No one knew. And if you're retired and during that, or about to retire, or just heaven forbid you retired in 2000, your gooses were cooked. It's not fun. If you're guiding these people, it's not fun. There's something to be said that a bird in the hand is better than two in the bush. It's safety, man. Yeah. Kenny, you've got, fire away, man. We're just saying I'm going off on a tangent. But the issue with these things is that we've had 10 years of a run, 12 years of a run. And I don't know what that means. I just, I did, Kenny. I did hear that Chris Hogan was let go from Dave Ramsey. That's too bad. Did you hear Marvin Hagler, how he died? He had just taken the vaccine, but how dare anyone put two and two together? Hank Aaron, how dare anyone? How dare you? I mean, who knows? Who knows how these guys died? I just find it interesting that to even suggest, could there be something there? People say, oh, you're an anti-vaxxer. I'm like, yeah, I don't know. But anyway, I'm 50. If I'm 60 today, I'll be upfront with you everything. I know what it's like being an advisor, advising people during the aughts. It friggin' sucked. I also know what it's like being an advisor, advising people in the aughts while my income is reliant on those people I'm advising. And that sucked because as the market goes down, my income goes down. I still got 4 kids and 6 mouths to feed, man. A mortgage. My wife wasn't working. She's working as a bank teller part-time. And we lived in Shenandoah Valley. We didn't have huge expenses, but it was huge for us relative to our income. And I'm just telling you, guaranteeing a portfolio back then in the real world isn't the word, even if it costs more, isn't the world thing that right on. Variable annuities have safety if we go into, and I'm actually talking about fixed index annuities here though, James. And it's fixed index annuities because they give you the downside mitigation. There's no downside risk other than the claims paying ability of the markets. But it's kind of going back because once you won the game, don't play. And a lot of economists will say buy tips. And I agree with that. Well, tips are just guarantee insurance contracts from the federal government. That's it. There's guaranteeing against inflation. That's it. They're guaranteed to get. They're literally tips as an insurance company, assurance contract to cover you for inflation, guaranteed by the federal government. But that's it. So they're good. But if economists can say buy tips, but why would the same economist then say don't buy a fixed index annuity? I'm telling you, man, I don't want it. So I'm 50 years old. I got 10 more years of plug. I can deal with the market decline because most of my debts are paid off except for this. My kids are older. Charlotte works, whatnot. And we have more set aside than we did back in the aughts. And, who knows what my income stream is, but I'm telling you, back then I made $36,000 in 2007, amigos, $36,000. We were looking at going on WIC. It was bad. And I'm not too proud to tell you the truth. Hell, we didn't make crap. And I knew 2008 was going to be worse because the markets were going down. No one was going into the market, which they should have been, but no one was because they were scared. No one knew. If we go through another scenario like that, it's going to be a challenge. Again, it's going to be a challenge for some people. It's be not a challenge for others. Others who stay in there because they're still working, still plugging. They got guaranteed income from annuities like Jill here, from like Harry. They're going to be just fine. But the other people are going to be like, damn, I should have taken I've heard this a million times a Sunday. I should have sold when the market was high back in 2000. I heard that 1,000 times. I was worth $1 million. Now I'm worth 300,000. I should have sold. I'm telling you, there's nothing worse than say you should have done that. And no one ever sits there and said, people say I should have bought Apple in 1997 when it was trading at $7 a share. I've heard that a hell of a lot less, or Amazon in 2000. Then I've heard I should have sold in 2000. I've heard I should have bought Apple and Amazon in 2000, whole lot less than I've heard I should have sold in 2000, which tells you the risk is always more dangerous than the reward is happy for the upside. Anyway, I'm going to do another video on this specifically. I just think there's some benefits on protecting the downside. I know people are going to say, oh, it's because you hate Biden. It's nothing. Maybe. But I was saying the same thing with Trump, man. I just said after what happened last year, I'm not convinced at all that the market is in a good place. I don't even know what the market is doing today. But Actually, let's take a gander. What are we doing today? I don't know. Looks like, yeah, hell, looks like, well, NASDAQ is breaking even. Russell 2000 is down 1%. Dow is up 0.5%. S&P looks like it's just above water. So we'll take it. But all right, looks like my Wi-Fi isn't doing that great either. So I'm going to do another one here. I'm not going to do a live stream tonight because my daughter. Well, maybe I will. Depends on. She has a game against our most. She has a game against our most wicked rival. I'm looking forward to seeing that. But anyway, I might, but we'll see what happens. But I definitely want to do a video on this. All right. Thanks, guys. Appreciate y'all being here. Don't forget to subscribe to Amar's channel. All right. I guess that's all I got. Thanks. We'll see you. Thanks now.